everybody? It's Hip Hop Stock Doc. We're going to cover real quick inflation risk. We've actually talked about this before in terms of your risk levels, where you're going to have investment risk, inflation risk, as well as longevity risk. But we definitely want to harp on the inflation risk right now, because if you don't know, inflation is roughly 3 to 4% per year. Okay, so that means that if you have $100 in 2015, that means that you need to have $103 to $104 in 2016 in order to have the same buying power. And buying power simply means, you think about like a pair of Jordans, where Jordans used to be like 120 bucks back in the 90s, and now they're what, like 180, $200? Well, that's because of inflation is factoring into that. So the buying power has increased. That price is actually probably the same when you compare it to that year before. It's kind of like when people always say, oh, so-and-so had $20,000 back in 1965. That was a lot of money at that time. So when you factor in, this is 2015, you have $100, you need to make sure that you account for inflation at 3 to 4% so you can have the same buying power. If that item in 2015 costs $100, you better have the 103, 104 to buy that same item. So when you're investing, you want to account for inflation with your investments. Now, overall, the stock market in general, particularly the S&P 500, tends to make about 5 to 6% per year in terms of returns. So that means you want to at least get what the market is giving you in 5 to 6%, because that way you can beat inflation by, what is this, roughly 2 to 3%. You know, let's say if it was 3% and you made 6, so you can beat it by roughly 2 to 3%. Now, of course, you always want to strive for more than the 5 to 6% return. However, you at least want to get that to beat inflation. And inflation risk is definitely important, because let's say you're making some investments and that investment is only getting, 1 to 2% per year. Well, in actuality, you're missing inflation by at least 1%. That means that if you, let's say you made an investment and you put $100 and that $100 turned into $101, but that same item that cost $100 this year costs $103 next year, you actually got to put in an extra $2 of your own money just to buy the same item. So whenever you're investing, you definitely want to make sure you account for inflation risk, because you want your gains to be more than the 3 to 4% in inflation every single year.